So hi everyone, my name is Andy Ervin and I'm the Deputy CIO here at Alumni Ventures. We're excited about today's session. Today's topic is the art of evaluating individual venture deals. Before we jump in, I first need to go through a few standard disclosures. So first, we're speaking today about Alumni Ventures and our views of the associated venture landscape. This presentation is for informational purposes only and is not an offer to buy or sell securities, which are only made pursuant to the formal offering documents for the fund. Next, please review important disclosures in the materials provided for the webinar, which you can access at av-funds.com/disclosures. And finally, a few housekeeping items. So first, you will not be on camera and you'll be muted throughout the entire presentation. We will record this webinar and share it with you after the event. I do encourage you to submit questions throughout the webinar. To ask questions, please enter them through the questions section of your GoToWebinar control panel and click submit. Taylor, one of our investor relations managers, is supporting us from behind the scenes and will help me field your questions. We've been amazed at the response and turnout for today's session so far. So if we don't get to your specific question today, we will do our best to follow up. And if you'd like to learn more about Alumni Ventures and investing in venture capital, I encourage you to book a call with one of our senior partners. They'd welcome the opportunity to speak with you directly. Taylor will put a link now in the chat where you can book time on their calendar. And he will also include a link to our secure data room where you can explore fund performance details or begin the process to become an investor with Alumni Ventures if that is of interest to you. All right, so our presenters for today are Mark Edwards, our Chief Investment Officer here at AV, and myself, Andy Ervin, Deputy CIO. Before I hand it over to Mark to introduce himself, my background includes being here at AV for the past 6 years in various investing capacities. Prior to that, I was on the other side of the table running finance and operations at a venture-backed startup based in Boston. And prior to that, I was in strategy consulting in the Parthenon Group, as well as an actuary at Liberty Mutual. Mark, over to you.
Yeah, good afternoon, everyone. It's Mark Edwards, Chief Investment Officer at Alumni Ventures. In my role as CIO, I oversee all of our investing activities across all of our different funds, which includes managing a team of some 50 full-time investment professionals located in our offices in Boston, New York, Chicago, Austin, and Menlo Park. By way of background, I've been involved with Alumni Ventures since its very early days. I first got introduced to the firm as an investor in one of the earliest, in fact, the original alumni fund, focusing on alumni of the Dartmouth community, Green D Ventures 1, investing my own money. And that started a relationship which sort of evolved into serving as a pretty active member of various outside investment committees and advising our CEO on specific matters, some of which related to some of the process that we're going to talk about today. I come from a background of about 20 years of investing in private markets as a private equity professional, leading leveraged buyouts and similar types of transactions for a few Manhattan-based institutional partnerships, and had the opportunity to join the leadership team of Alumni Ventures about 18 months ago. And as I said, now I'm Chief Investment Officer and member of the board. Next slide.
Getting into the agenda. So today we're going to walk through venture capital as an asset class, a quick overview of what venture capital is, and a little bit more about AV's role in this space. Then we'll get into the meat of the presentation of how AV evaluates deals, and then we'll talk a bit about syndications, which are really opportunities for AV investors to flex their deal evaluation muscles on their own. And then finally, we'll open it up for Q&A. So next slide, and Mark, over to you.
Great, thank you. So we've got a relatively large audience today, and I think a lot of people with varying levels of experience and exposure to venture capital. So getting started, we'll just provide some background just to level set. First is, we're going to be talking today about venture capital as an asset class and how we as a company execute against it. What is venture capital? At its core, it is an investment strategy that's focused on investing in equity securities of relatively young operating companies. So we are buying stakes in businesses, ownership stakes in businesses, as opposed to investing in loans or bonds or anything of that nature. And the underlying investment that we're evaluating is an operating business where the value will be created if that company gets traction in the marketplace and increases its revenue and earnings and the associated value over time. So there's, it's not as if we're investing in hard assets or currencies or commodities or anything of that nature. We are really trying to identify promising businesses that can grow into companies along the lines of what you see on this slide here. What makes venture capital sort of distinct as a marketplace is, number one, it's private. So all of the companies that we are invested in and other people in the venture capital market are privately negotiated transactions between people who manage money and companies that are looking to raise money. You can't create investments in this asset class by going to any listed exchange, nor can you seek to sell things easily through any sort of managed exchange. So it's a long-term asset class which has sort of demonstrated its value over time, but does not have the liquidity that comes with a lot of other sort of equity alternatives. In addition to that, the strategy tends very much to focus on young companies. So we certainly back a range of businesses, from things that are as early as a founding team and an idea, all the way to businesses that are demonstrating a lot of traction, but again, they are distinctly in the private markets, and sort of all things in between. And I'd say the third and final kind of characteristic of the types of companies that end up in a venture capital portfolio is that they tend to have very big aspirations. If your neighbor is thinking about starting a chain of laundromats, it may be a very compelling cash-on-cash investment opportunity, but it's probably not the type of situation that's going to resonate with venture capital investors. The businesses tend to be ones that are focusing on disruption in very large addressable markets, and tend to have a strategy that's built around innovation, technology, intellectual property. So you'll see a lot of businesses like the ones again listed here that sort of have those types of characteristics. Next slide. So traditionally, and even to this day, venture capital has tended to be sort of the revolve around private partnerships that are generally serving a fairly select number of institutional investors drawn from the worlds of pensions, endowments, sovereign wealth funds, those types of pools of capital. And by their definition, an individual investor is probably somebody who can write a $5 to $10 million commitment. Alumni Ventures was sort of founded around the notion several years ago that there's an opportunity to present similarly professionally managed venture portfolios, but make them available to accredited investors who otherwise or generally have limited access to getting exposure to this important asset class. We've been at it now for several years. You can see here we've grown to serving the needs of more than 9,000 individual investors with us. We have grown over that period of time to be the #1 most active investor in the venture landscape, judged by the number of companies that we back in 2022. And we've accumulated over that period of time a portfolio representing in excess of $1 billion of cost and growing, and representing discrete investments in about 1,100 portfolio companies. And as I mentioned before, a lot of the work of constructing and managing this portfolio, which Andy and I manage, is really the hard work of a group of teams that are spread out throughout the country that add up to about 50 full-time venture investors. The slide on the right just quickly shows, to date, we feel like we're off to a good start. Given the work that goes into portfolio construction and the lack of liquidity, the expectation is that by putting your money into this asset class, you want to outperform what you can achieve in public markets. And this slide shows that we are tracking to several hundred basis points of outperformance, based on our performance to date. Next slide. So given the volume of investing activity that we have to navigate in order to construct the portfolio that I just discussed, and continue to add to it every year. We are evaluating a lot of individual investment opportunities. Drinking from a fire hose is sort of the description that frequently comes to mind. And the VC business, like a lot of investment businesses, is really a business of saying no and eliminating a lot of the inbound opportunities to really climb the wall of worry through due diligence and find the best of the best, which represents a very small percentage of the number of opportunities that we get to evaluate. So in order to do that consistently and with intellectual honesty, we need to have a pretty well-established process that everybody understands, buys into, and abides by, just in order to handle the volume and drive the investment performance results that I showed on the previous page. And we've distilled this down into a consistent process and an underlying scorecard. And we wanted to use today's webinar to take people through the thought process behind that scorecard, how we manage our process using it as an important tool, and share the details for you so that you can understand how we think about deal evaluation and maybe even incorporate a similar approach or the exact same approach as you think about making your own personal investment decisions. So with that, I think I'll turn it over to Andy.
Great, thanks, Mark. So the first category of the scorecard that Mark described is deal dynamics. So really digging into how the round has been structured. And there are three main subcategories here. And I'll say, remember that AV is purely a co-investor, meaning that we don't lead rounds, don't set terms. So all of these evaluation criteria need to be viewed through that lens. First category, round composition. So is the round being led by a brand new investor, meaning this is the first time that firm is investing, or is it being led by an insider, a firm who's already sunk capital into the company in prior rounds? And if you think about it, you can understand how this leads to different incentives of that lead investor. And when I say lead investor, I'm talking about the one setting the terms of the round, setting the valuation, structure, etc. So if I'm a VC that has already sunk, for example, $10 million into a given company, I have different motives compared to a VC that has never invested before and who's maybe writing a check in the current round as a brand new investor. So all else equal, AV prefers to be investing alongside a brand new investor, as our incentives are more purely aligned. However, there are certainly exceptions to this. Sometimes a company is killing it, growing rapidly, and so existing investors step up and offer the company a term sheet to prevent that company from raising outside capital. So that's also a good situation to be investing into. The trick is really digging into the motivations at play, the players around the table, and understanding the dynamics of that round. Valuation and terms, next one. So this is about how the deal has been structured, including valuation of the company, meaning how much the company investors will own after they invest, plus other special rights, liquidation preferences, etc. And we evaluate this based on both internal and external data. And essentially, we're looking for how the terms of the deal compare to average, quote unquote, for the company's stage and sector. Finally, we've got runway. So based on the amount of capital the company is raising, how long can they go before they need to go back out to market and raise another round? For example, if a company is spending $2 million per month to keep its business running and raises a $15 million round, that really only gives them 6 months or so before they need to fundraise again. And this is important because if you want a company to be able, or you do want a company to be able to achieve proof points and a step up in valuation prior to their next round. So at AV, we're typically looking for at least 18 months to 24 months of runway for a company that's raising a round. And this number can change slightly based on the stage of the company, but that 18-month is really the minimum. And on the right-hand side here, a quick example of an AV investment that I wanted to highlight in this category is a company called Yassir, which is a super app targeting French-speaking Africa. The company raised a Series B last year, and Mary Meeker's firm Bond Capital came in and wrote a $100 million check of the total $150 million round. Bond was a brand new investor, so we viewed this investment as a great signal, demonstrating one, the lead investor's belief in the company, but also, it was purely aligned with AV's incentives investing in that round as well. All right, next slide, over to you, Mark.
Thank you. So scorecard category 2 is an evaluation of the lead investor. As Andy mentioned, our role and our go-to-market approach is not to try and lead rounds ourselves, but rather to be the co-investor of choice with other investors that sort of take the primary role of negotiating terms and then post-closing, sort of exercising the governance of board oversight and those types of things. And so with that approach, it's very important for us to understand and have a high degree of confidence in who those lead investors are. If people on the phone are sort of experienced public market investors in mutual funds or other products of that nature, you know that there's a lot of managers out there and very few of them systematically outperform the quote market over any extended period of time. Which is why for some names like Peter Lynch and Bill Miller resonate with people, because they were one of the very few to be able to accomplish that for any meaningful period of time. For a whole bunch of reasons, the venture industry is slightly different. It's still intensely competitive, still very difficult to systematically outperform, but there are a number of firms that have demonstrated a pretty consistent ability to generate higher than above average returns. And what's interesting about those firms is that they tend to do it for extended periods of time. So a big focus of ours is to be aligning ourselves as best we can with the investors that we think are most well positioned to generate those above market returns. Lead investor, firm quality, and track record is sort of the first screen to try and focus our portfolio on being in the right deals with the right lead investors. In addition to sort of their historical investment performance and sort of the similarity of where those outside gains have come from relative to the specific company that we're evaluating, there's a couple of indicators that demonstrate that this lead investor has a high level of conviction in his or her decision making. Apologies. And that comes into the size of the check that they're writing, both in absolute dollar amounts, but also as a percentage of the amount that the company is raising. Obviously, the willingness to commit time to serving on the board of directors, which most partners at venture firms abide by a limitation on that, because in order to do the job correctly, you have a limited number of seats that you can truly serve in appropriately. So some of those indicators of the level of conviction in the investment is an important part of our thought process. And then we take it one step further to not only ascribe success to the identity of the firm that's leading the round, but really dig into the specific partner who's going to be the point person on the investment and understand level of expertise in the specific industry area that the company's operating in, historical performance of both winners and losers that have some relevance, to the investment thesis of the deal that we're evaluating, and try to get a sense of the partner's aptitude to be a good steward and advisor to a CEO, sort of as it navigates his or her journey, because that very often can be a separate skill from company identification and sort of the analysis that goes into making an investment decision. You have to live with these deals for, in some cases, a decade before you can know that you have a success or not. One example of an investment that we made that sort of stood out in our minds in terms of understanding the quality of the lead investor is a cloud security business called Lacework. And this was a round that we invested in back in 2018, sponsored by a firm called Sutter Hill Ventures, that takes a very, very sort of specific approach to their portfolio, where they tend to be much more focused on a concentrated number of investments where they have high conviction, and they invest early and stay with the company as it continues to mature. So, fewer deals that they sponsor, but have had tremendous success with that approach. If anybody's familiar with the data as a service company Snowflake, that was one of the products of Sutter Hill's approach. So we had an opportunity to invest alongside them, like I said, in this $20 million round, and took a lot of comfort from knowing that they were significantly invested in the business And fast forward to 2023, we feel pretty good about that investment decision. Andy?
Great. All right, the third category of our scorecard is execution. This is essentially the typical diligence questions around how the company has been performing. So first off, customer demand. And we would evaluate this one differently based on the stage of the company, but essentially, has the company proved customer willingness to pay? Have they secured revenue and paying customers? Or depending on the industry, have they overcome certain industry-specific hurdles, such as FDA approval for biotech? Next up is the business model. So how profitable and scalable is the mousetrap that that company has built? Company momentum is next. We want to catch a company at the beginning of a big upswing as opposed to at the top of that upswing. You're going to get more bang for your buck when you get into that company early. Capital efficiency. So how well has the management team used the capital that they've raised to date? Are they a scrappy team that's making every dollar last, or have they spent fairly frivolously in the past? This is usually a good indication of how they'll use the next round of capital that they raise. And then finally, competitive moats. What's the company's differentiation or secret sauce? And is that going to be enough to allow them to outperform competitors as they grow? And a good example of a prior AV investment that I wanted to highlight here is Deliver. They were raising a Series C back in 2019. And when that round was raised, they were just killing it. They were up, I think, 10x year over year in terms of revenue. It just closed on partnership with Walmart. And it's a great example of catching a company at the beginning of that upswing. This company was eventually acquired by Shopify, I think about a year ago. So it was a great outcome. Mark, back to you.
Thank you. So fourth category is evaluation of leadership management team, which is probably a blinding glimpse of the obvious, but in all businesses, but particularly with early stage ventures, for all of the analysis that we do in the first three categories that we discussed, developing confidence and conviction of the ability of certainly the CEO, but the team below him or her to execute is really critical threshold piece of our analysis. So there's obviously some desk work that goes into understanding the history, track record, experience, and outcomes of the leadership team and evaluating deals for investments that sort of pass initial screen, and we really try and do a lot more diligence. I would say the overwhelming focus of that diligence is to get comfort with the management team through interactions, asking them questions about their business, and just get a detailed understanding of their demeanor, their sense of vision, and sort of strategic insight, their ability to sort of focus on executing a plan and being accountable, their ability to recruit and retain talent, to lead, multidimensional, but a critical piece of the diligence process. And this is sort of distilled down to a specific score, when we make our final investment decisions. Highlighted here is the company FormLogic. This is a very interesting, business where we first got invested in 2021. It is an innovative manufacturer of highly machined precision parts. Very, very strong supplier, as an example, into SpaceX, which is Elon Musk's space exploration business. So a moonshot, literally. And the deal passed muster on a lot of all of the different dimensions that we evaluated. But CEO Paul Sutter really stood out because he came into this business, which doesn't have a lot of historical, sort of analogs to compare to, because it's a very innovative company, but had a history of building two other businesses and seeing them through to successful exits, important companies that were great results for his investors. And in addition, building a business, up to $400 million of revenue, which puts it in fairly elite company amongst startup land. So a big piece of the analysis here was a high degree of comfort with backing a leader like Paul. Okay, so we'll Go to the next slide. And here, just quickly, I wanted to mention, we've covered a lot of material in a short period of time. We have put a downloadable handout for people on the call that sort of provides an overview and a summary of the deal evaluation process. And so if you navigate to the control panel, there'll be a document icon that you can click on and get access to it. So back to the presentation. We talked about it earlier. You know, a big piece of the deal evaluation process that we just reviewed is just a function of the volume of business that we're doing. It takes a lot of prospect review to kind of distill that opportunity set down into a portfolio that we feel good about. And just to give you a sense of kind of the shape of the funnel, keep in mind we've got an existing portfolio of about 1,100 companies. You know, on any given month, we are approached or we are in the market evaluating 500 plus deals at a time. Very, very big top of the funnel. And, you know, the art in this is to distill all of those down to what we think are the best opportunities according to the metrics that we just outlined, and apply a screening process across all of our investment teams, all of our offices, all of the people that have input into making our final investment decision, that has a level of consistency so that the result of our decision making that comes out the back end is done you know, with regularity, efficiency, and most importantly, consistency of outcome. So I think this funnel slide kind of gives you an indication of that. If we go to the next slide, the net result of taking things through that funnel and sort of making the investment decisions that we make is represented here. So we have a bunch of different product offerings, if you will, that all follow the same process in terms of investment decision that we talked about, but really are designed to enable our investors to have some level of control and, if interested, customization over what the makeup of their overall portfolio looks like. You know, at our core, what we offer is diversified portfolios where we construct over about a 12-month deployment period a collection of 20 to 30 individual businesses, and we aim to build that portfolio being mindful of having broad diversification across sector of the economy, stage of development, geography, and things like that, so that that portfolio is not overweighted unnecessarily to any one of those dimensions. And that's really kind of our core offering. You can see here on the slide, we talk about alumni funds, which are diversified portfolios, you know, constructed with a view to the underlying school communities that make them up. We also have similarly constructed portfolios that we call focus funds, which give an investor a chance to invest in a portfolio of several companies, but have them have some thematic relationship. So if you happen to have a point of view that you think it's a very interesting time to be investing in innovative healthcare companies, as an example, you can get more exposure to the healthcare sector than you would be able to get through an alumni fund, through one of our focus funds. And as you go kind of down the line, we have another product that we refer to as syndications. And syndications give investors who probably are a little bit less inclined just to sort of set it and forget it, but really have a desire to develop their own venture decision-making muscle, and or have high conviction about a certain sector of the economy or a certain lead investor, or whatever the dimension is, that they say, I want to allocate a portion of the amount of money that I'm investing in venture to having a little bit more concentrated position in some single company investments. So syndications make up businesses that we have run through our process, made an investment decision, one or several of our diversified funds will be investing in it, but we've been able to get some additional allocation in that specific company, and we can offer it directly to our investors so they can make a single company investment decision. And as we go through that process, Andy will explain, we will share all of our due diligence materials so that you can perform your own review, and you may come to a different decision from what we came to, or you may agree with our decision. but now you'll know that it's sort of passed through the scorecard process that we just described. And if it's of interest to you, we have a fairly steady volume of these types of things that we like to offer directly to our investors. The one caveat I should say is that this program is only made available to investors that have an investment in one of our diversified funds.
All right. Thanks, Mark. All right, so as Mark mentioned, syndications are opportunities to invest in a single venture deal where we're able to secure incremental allocation above what our funds are investing. And as Mark mentioned, we were able to take this extra allocation and put it in front of existing AV investors, sharing our diligence material, and we typically give them about a week to make a decision. So give you time to digest the information, read through the material, and decide whether or not you want to make an investment. And it's important to note that allocations vary and frankly sometimes change. So this can inform how many AV investors see a given syndication, and it sometimes results in us cutting investors back from the amount that they initially wanted, as the demand for a given syndication may outstrip our allocation. These are usually real-time negotiations that we're having with each of these companies. And you may ask yourself, why would a company give us incremental allocation to offer our individual investors? There really are a lot of reasons, but they typically revolve around the value that we can bring to the table. For example, take a consumer product company. Having that company presented to a large number of high net worth, well-educated consumers that make up AV's investor set, that's extremely valuable. So that's just one example of why companies may jump at an opportunity to syndicate like this. The other point I want to make is that the minimum check size for syndications is $5,000, and this is a very deliberate effort from us. It's lower than the minimum check size to access any of our funds. The reason is that we want our investors building diversified portfolios. Syndications are highly risky investments. The nature of venture investing, as Mark pointed out, is that you have a lot of zeros, with relatively few investments producing big outsized returns. So we don't believe any of our investors should be putting, half their investable capital, for example, into a single deal. It's more about diversification, and customizing your existing portfolio with certain opportunities that you want a little bit more exposure to. Next slide, please. So when you see a syndication opportunity come through, you'll be presented the option to log into our secure data room, where we provide the key diligence material for that deal. And this typically includes the material you see here on the left, including the diligence report. This is AV's assessment of the opportunity and our rationale for investing. And I would argue this is the most important document to review during this process. Then we include the investor presentation. So this is the pitch deck directly from the company, so you can see how the company is presenting itself and kind of removing AV's take on the deal. Next up is the term sheet. So this shows the detailed terms of the deal, more of a legal doc that we typically summarize in our diligence report. But if you want to learn more about how a round is structured, this is a good place to look. Capitalization table is next. This shows the relative ownership of different investors around the table. And this gets at that deal dynamics that I highlighted earlier in the presentation. Who are the different players around the table, and what are their motivations? And then finally, financials. So these are company provided historical financials and projections, so you can see how the company is thinking about the future in terms of financial results. Again, in our diligence report, we may discuss our own take on financials, but you may want to see the financial projections from the company's voice itself. There are sometimes other documents provided in our data room, depending on the deal, depending on the industry, but this is really the core set that we normally provide. Next slide, please. All right, so a few example syndications I wanted to highlight quickly. And actually, the main point here is that we present a lot of different types of syndication deals, a lot of variety by industry, by stage, by geography, all over the place. It's not just like one specific segment that we try to syndicate. So on the left, we have Mythical Games, a platform for player-owned economies. We originally invested back in 2019, and their latest round was raised in 2021, led by Andreessen Horowitz. Next up is Data.World, which is metadata management. Originally invested back in 2020, and their most recent round was led by Goldman Sachs. Hydro is next, which is a connected fitness platform. Think Peloton for rowing. We've invested a couple times in this company, and their most recent round was led by L. Catterton. And then finally, Fleet Space, which is a network of microsatellites doing some really exciting work for customers in the mineral extraction and mining space. This is a deal we originally invested back in 2020 and actually just completed a follow-on investment, including the syndication earlier this year. In fact, every one of the companies that we've listed here, we have anywhere in this presentation, we've syndicated in the past. All right, next slide, please. All right, so finally, before we jump into Q&A, I wanted to mention that if you'd like to learn more about upcoming syndication opportunities, including one launching tomorrow, please click on the link listed here. Remember that these opportunities, as Mark mentioned, are only available to existing AV investors. All right, and with that, why don't we get into Q&A? That's the next slide, right? Thank you, everyone. Thank you for everyone in the audience for joining us. A very special thank you to those of you who submitted questions. Again, sorry we weren't able to get to all the questions submitted. We will follow up with those of you that we can. And finally, once the webinar ends, you'll see a quick 4-question survey on your screen. We'd appreciate you filling this out so we can continue to make these webinars better. Thanks again for your time, and enjoy the rest of your day.